Okay, so now we're going to look at the closing entries and the post-closing trial balance. And like I said before, from this point on, you're not going to see a full worksheet very much anymore, because they're going to assume that you understand what this looks like and why we did it. Okay, so what we did before when we started looking at closing entries is we looked at our income statement columns and basically, well, at the beginning of accounting 1 we said sales closes into income summary, expenses close into income summary, but really and truly when we got to authentic threads I explained that everything in the credit column closes into income summary, which is your sales and your purchase discounts and returns and allowances. And then everything that's in the debit column closes into income summary. So that's the first two closing entries. And then we get our net income and our dividends closing. So because we don't have this full worksheet, what we need to understand is that we've got an adjusted trial balance column that basically mirrors that same thing, right? This section right here is exactly this section because we directly transferred from the adjusted trial balance to the income statement columns that information, right? Because this is after those adjustments anyway, okay? So with our work in our book, all we have is the adjusted trial balance. So again, visualizing that this information, okay, because this is the second page of it, right? Here's assets, liabilities, owner's equity, revenue, and expenses. This is that bottom half of that worksheet, and it's our adjusted trial balance. So these are the numbers that belong on the income statement. These are the numbers we used on the income statement. Okay? We really can't use the income statement for this just because the income statement's not set up as debit and credit. So this is a whole lot easier to use. Okay? So there are 4 closing entries. All right? It's closing the credit column into income summary, and then closing the debit column into income summary. If we got to close these credits, we have to close it with a debit, right? So to get this to 0, we're going to create a debit for sales, and then if we create a debit, we have to create a credit somewhere else, and that credit somewhere else is the credit to income summary. Okay? Same thing here. Everything in the debit column has to close. Well, actually, we're not going to use that income summary because that's already posted because that was the adjustment, okay? So that's kind of a special thing. So this is what we're looking at for closing, right? Okay, so these are the closing entries. We're going to ignore that income summary, and I'll talk a little bit more about that in a second. Okay? All right, so if I've got a debit here, I've got to close it, I've got to zero it out with the credit, and then if I zero it out with the credit, I've got to have a debit somewhere for that closing entry, and that's income summary. Okay? So instead of me writing all out, I'm just going to show you what I've got, and we're going to draw on it. You'll need to, for your notes, go ahead and write it all out. But just so you don't have to wait for me to do this, okay? So again, I'm pulling everything. At this point, I'm pulling things from this adjusted trial balance, okay? So this is what the closing entries will look like. And let's go ahead and up here write what those 4 closing entries are, if we can fit this in here, okay? So all income statement credit columns. All right, so that's the first thing that we close is all income statement credit columns close into income summary. All right, and then the second one is all income statement debit columns close into income summary. All right. The third one, we're going to squeeze this in here, is that income summary and I'm going to put a little note here, net income closes to retained earnings. Okay. And then the fourth one is that dividends closes to retained earnings. All right, so hopefully you can kind of follow that. Okay, those are the 4 closing entries that we have. So the first thing is to take everything that's in the credit column. So it's going to be sales, it's going to be purchase discounts, it's going to be purchase returns and allowances, and it's going to be interest income. Right? Those 4. Sales, purchase discounts, purchase return and allowance, interest income. Those are 4 credits right here. Okay? And if we need these to zero out, they have to be a debit here. And if we have a debit here, we have to have a credit in that transaction. So income summary is our credit. Okay? So that's the first, right? That's the first transaction right there. Or the first closing entry. Okay? Now when we do that, let's see if I want you to think about the T for income summary. Okay? Now, I'm going to jump backwards a little bit, right back to this, because I said we were going to ignore it for a little bit. Okay? Notice that in income summary, there is a debit sitting there of 577189. Do you remember where that number came from? Again, they're going to force you to think about that worksheet. Okay, now this isn't the same numbers. This is a completely different worksheet, right? But let's look at income summary. Why is that number sitting there? Where's income summary? Right here. That number sitting there. Okay, 3690. Well, where's the 3690? It's right there. Remember the merchandise inventory? This was our beginning inventory. This was our ending inventory. How did we get from here to here? We had to make an adjustment. Sometimes it's a debit, sometimes it's a credit. It just depends on how we bought and sold throughout the year. There's nothing good or bad about a debit or a credit. But we have to have something to go with that adjustment. And that goes into merchandise inventory. Okay? So you have to think about this number has already been journalized and posted because we have already posted our adjustments. Okay, so that number is sitting in income summary. Okay, so in this case, it is sitting in income summary as a debit. 577189. Okay, then when we take all of our income statement credit columns and we close them, right, they're also going into income summary. Oh, excuse me. Nope, they're going to income summary as a credit because we closed them with a debit. Okay, so this one's coming right here. Okay, and then when we take this one and we close all of our expenses, right, that income summary is the debit. So that one's going right there. Okay, so the difference between these two plus that number, okay, means that whatever's sitting in income summary should be net income. Sorry, let me slide this over. Okay, so if we were to go ahead and after these two, we were to post, okay, when we got down here to this will be net income. Gotta slide that back up. Okay, so then our second, sorry, I think I kind of jumped ahead because I want to draw those arrows. Okay, so the second closing entry is to close all of the debit columns here, not including the income summary, right? But closing all of these with a credit, add them all up. Here's the debit to income summary, right? So this is transaction, or the second closing entry. Okay, and then that second closing entry brings that amount to the debit side of the income summary. Okay, so then, like I said, there's a couple different ways you can look at how to do this third entry. Okay, it should be net income. So if you jump back to your income statement, that's the number it should be, net income after taxes. Okay, that number should also match the number that's in the ledger if you've posted the first two closing entries. Now, we don't usually post these until we get all of them done, but it would be a good idea to do that so that you can double check to make sure that that balance in the ledger is matching the net income after taxes. Okay, now these two, again, is basically doing what we've done a couple of different times. It's taking the net income and transferring it to the owner, right? The net income belongs to the owners. Okay, and then it's also in this last one, it's taking the dividends, which is money we paid out to the owners, and reducing the retained earnings by that amount. Okay, so this is number 3, and this is number 4. And this number right here basically should be net income. All right. So that's kind of the quick overview for closing entries. The next step would be to post these closing entries, and remember, when you do that, all of these expense accounts zero out, right? Everything in here zeroes out, right? Except for retained earnings. We don't want retained earnings to zero out, but that's the whole point of this, is to transfer the net income to the owner and close out some of these accounts, so that we can start fresh for the next year and keep track of these expenses year by year and not accumulate them between years. Okay? All right, so then for 16.5, they want you to do a post-closing trial balance. But you haven't truly posted. You don't have ledgers in front of you. So I will say that in the book, let me just show you real quick. The book is giving you all of the balances that you should have for those ledgers. What it doesn't give you is it doesn't give you whether it's a debit or credit. Okay, so that's the part that you kind of have to know. What's the normal balance for cash? What's the normal balance for petty cash, accounts receivable, and so on. Okay, so that's the part you'll kind of just need to take notes on, or take note of, when you're going through the post-closing trial balance. Okay, again, this is what it should look like. You've got the numbers in the book. Again, what's the normal balance, right, for these accounts? You know, use the normal balance side. Okay, at this point we're not going to have anything that's gone negative, so that's where we need to be. So just use the numbers in the book. Again, cash, petty cash, all your assets have a normal balance of a debit. This is a contra account to accounts receivable, so it's going to have a normal balance of a credit. That's an asset, that's an asset, that's an asset. Here are your payables. Your payables have a normal balance of a credit. Your owner's equity has a normal balance of a credit, which is also retained earnings. That's your owner's equity. Okay, capital stock, owner's equity, all right there, stockholders' equity. Okay, so this goes back to those very basic things we learned in the first couple of weeks of Accounting 1. What's your normal balance for all of these accounts? You still have to know it. You can't forget it, right? You have to understand the worksheet. You have to understand the basics of an income statement and a balance sheet and stockholders' equity